fresh bout of selling causes a bigger dent in caps with the declines widely outnumbering advances. Realty, metals and energy are the big drags while IT and FMCG still see small gains.
A ramp up in large deals, strong India business and a welcome pickup in the BFSI segment drives a strong growth surprise for Infosys, which also raises its guidance for the year. The stock gains.
Persistent Systems sees a sharp fall on posting a dip in profit margins while lower than expected volumes due to a shutdown at JSW Steel's unit dents JSW Infra's revenues and profits.
Reliance Industries is expected to clock healthy revenue growth, but a decline in gross refining margins for the industry could impact profitability. The street, however, is more focused on possible clues to the listing of its retail and telecom arms.
Hello and welcome. Good afternoon. You're watching us here on Halftime Report. I'm Mangla Malu. With me, as always, Ekta Batra. It is a time where we're seeing some bit of sell-off on the markets. A 165-point cut on the Nifty from record highs yesterday. The pain in the broader market is a lot more, with a near 1,200-point decline that we're seeing on that index, and more so if you look at the advanced decline ratios. 2,000 stocks on the upwards side, with about 300 stocks which are gaining. So from record highs, we have seen some bit of consolidation. Currently seeing a bit of fear, maybe ahead of the big events, which are the budget next week and the big results that we're looking at, Ekta.
Hi, Mangla. Well, not used to it, right? Seeing that red on the screen. So yes, definitely. The mid-cap index is down around 2% at this point in time. Let's see whether there's any kind of buying at lower levels. Like Mangla mentioned, we do have the budget, which is coming upon us next Tuesday. So that's probably where we are seeing some amount of profit taking. And not to mention that the US markets were lower overnight as well. The Dow also snapped its 6-session winning streak. So maybe that could be something which added an additional amount of pressure. But just want to add that the big star for the entire week and for today continues to be the entire Nifty IT index, which is up around 2.8% on a week-to-date basis. And on a week-to-date basis, Infosys obviously is the star for today because of its numbers, but nonetheless, it's up around 5.9% on a week-to-date basis. LTI, Mindtree, TCS, HCL Tech, all of these stocks have rallied anywhere between 2.5 to 3% and we'll be getting more cues from Wipro, which releases its numbers today. So that seems to be the core focus. But let's talk about one particular company. Sandstar's 510 crore IPO has opened for subscription today. The IPO comprises of a fresh issue of 397 crores and an offer for sale of around 113 odd crores. Through the IPO proceeds, the company plans to more than double the capacity at its Dhule plant and will repay borrowings worth around 100 crores as well. To discuss more on the IPO, we have with us the two companies' joint MDs, who are also brothers, Sambhav Chaudhary and Shreyans Chaudhary, in the studio to take us through the details. And it's important to mention that it's in fact subscribed. The IPO is subscribed in the first hour itself. So tell us a little bit, before we talk about the business model, which is quite interesting, just wanted to understand the repayment of 100 crores in terms of debt out of that 510 crores that you're raising. How much do you have in terms of debt on your books right now? How much do you have in terms of cash? How much is going towards repayment? And what's the eventual goal for debt reduction?
Thank you so much, first of all, Manglam and Ekta, for having us here. On the debt side, we have a total debt of approximately 140 crores on the books, out of which 35 is long-term, and the balancing figure would be a short-term debt. And out of the IPO proceeds, we plan to repay approximately 100 crores towards the debt repayment. And going forward in the next year, the company is going to be completely debt-free. We are generating approximately, in the last financial year, we've generated approximately 90 crores of positive cash flows in the company. And we hope to continue that as well.
All right. When I look at the business that you're doing, the third largest manufacturer of maize-based specialty products and ingredient solutions, you basically sell to a lot of the food processing agencies, etc. At the same time, you don't have any long-term contracts with the people you source your maize from. Do you have long-term contracts with your customers? Because it seems like a commoditized business where someone can come undercut the prices, etc. So in light of that, what exactly is your moat out here?
So the company is primarily driven into sales to food. Almost 60% of our revenues is coming in from sales to food, FMCG, or processed food industries. So the entry and exit barriers are very high to these industries. The company is having a very good name for itself in the overseas markets. As you can see, almost 400 crores or 36% almost total revenue coming in from exports market. A lot of new applications are coming in that seem to be driving. So there is a lot of value addition and a lot of second generation derivatives that we manufacture. So we are not very directly exposed to any volatility in terms of raw material prices. It is fairly easy for us to pass on any prices. As a company prudent policy, we do not enter into any long-term contracts. Our buyers typically come and buy on a monthly or a quarterly basis.
Okay. All right. You know, what's interesting is that you mentioned that you export to around 49 countries and you have around 33% of your sales coming in from exports. Tell us, how is that vertical growing vis-a-vis the domestic market? And within the exports, what do you see as the key driver of growth? Within domestic markets, what is the key driver of growth?
So globally, a lot of new applications are coming up within the plant-based specialty products that we do. If you see globally on the Western Hemisphere, there is a boom towards plant-based foods, plant-based clothing, leather, shoes, etc. Even on the personal care space, we see now companies shifting to these plant-based products that we are manufacturing,
right,
rather than a talc or the more lesser friendly bodies applications. So one is, of course, these all new applications that are driving. Plus post-COVID, we have seen a lot of interest towards our industry for India. A lot of large companies wish to set up their supply chain within India. So on an overall picture, this is all driving the demand globally.
But how much is the vertical in exports growing? How much is the vertical in domestic growing? What's the growth rate?
We were like 36% on the export number. Going ahead with the expansion and the demand that we see post doubling of the capacity that Sandstar has already started, we hope to maintain the same share. We see that kind of demand going ahead as well within the export market.
Let's talk about the capacity expansion itself. 181 crores is what you are, earmarking for capacity expansion. I look at your gross block, which has increased over the last 3 years already, and that's led to a revenue jump as well. So what are typically the asset turns that you have on a business like this? And with this near 200 crore capacity addition, what could the incremental revenue look like?
So, I mean, we've positively maintained a very nice asset turnover, probably of around 5 to 6,
okay,
which is also one of the best in the industry per se. And with the expansion of around 200 crore rupees, out of which 20 crores have already been spent on the expansion, and out of the IPO proceeds, 180 crores would be spent on the upcoming expansion. We plan to maintain a similar asset turnover ratio or even better.
So if I have to extrapolate those numbers, last year you did revenues of close to around 1,067 crores, additional 200 crore capacity. When does that come on stream? And with this 5-6 times turnover, when do you reach that 2,000 crore mark, by 2,000, 2,200 crores?
So, I mean, we plan to complete the expansion by June 2025.
Okay.
The financial year 25-26 will have 9 months of that expansion. So, hopefully, in the 25-26, we aim to double our revenues from the existing.
Okay.
With the expansion coming in, because we are doubling the capacity from 1,100 to 2,100 tons.
Okay, so these 49 countries that you're exporting to are mainly semi-regulated countries?
In our products, because these products we need on a very daily basis, there's not much regulations. We don't see any import restrictions or even for say export restrictions. So we don't see any regulations within our space for these.
Is there a
so
risk?
it's easy. Just what about the developed countries? Say, for example, US, Europe, your exposure to, say, countries such as that, as well as maybe Australia, because regulatory, barriers would probably be more there.
Yeah, so because of the demand avenues that we and that because our plants are very proficient in terms of producing a very high quality, the plants are automated, and a very good food safety certification quality system that we have in place. So, so there is acceptability for these products now post the plant audits, of course, that happen. So there is a good acceptability for these products within the Western markets also. We've exported to the Americas as well in the last financial year. So new markets and new geographies are opening up for us.
Who are your competitors in India? What is their size? And, what are the margin triggers? Because again, like I said, this is a commodity. You buyers need this product daily, and you guys need to buy from your suppliers daily or on a very regular basis. So the ones who typically give you the best price is something that will win.
No, so what really happens is, the raw material input might be a commodity, but the products which we are manufacturing are more towards, we we work very closely with our customers to get the plants approved, audited. And I mean, a typically FMCG customer would have a lot of audits going on in the plant. So the barriers to entry for these kind of products would be very high, though the input raw material might be commoditized. Also, I mean, you know, the audit time would take anywhere between 6 months to 12 months per se for any of the FMCG companies to do that.
So who would your competitors be and what are the margin triggers?
Our competitors would be Gujarat Ambuja Exports and Gulshan Polyols.
Okay, and what would your global competitors be, just to get a sense in terms of the kind of share that you probably have globally? Who are you competing with on a global scale?
Yeah, so as per the Frost & Sullivan industry study, it's a $70 billion global industry for the plant-based, maize-based specialty products that we make. And some of the larger names that exist and that have a play in this industry include the like of Cargill, Louis Dreyfus, Archer Daniel Midlands.
Okay. Any kind of M&A or expansion strategy that you would have on an inorganic basis within this space?
I think we're open to that, but as of now, we don't have any thing in place, you know. But as and when the opportunity arises, we would definitely be open to that.
I may sound like a broken record out here, but margins, that's what I want to know. Because on a 1,000 crore top line, you're doing barely 100 crores of EBITDA. What is the kind of margin trigger that you have? Because when you're doing 2,000 crores, you know, what should one pencil in?
So majority of the product, the expansion are all coming in on the derivative side, the second generation derivatives that we mentioned of. Some of the products are even going into pharmaceutical applications. So going ahead, because of this positioning, we do anticipate margin improvements, EBITDA
How
expansions.
much? 200 basis points, 300 basis points?
Hopefully, because we've also made, the company has also made some recent investments on renewables, on solar as well as biogas based electricity. So those are all, and plus along with the capacities of scale that we are going to achieve at 1750 tons per day, my Dhule plant is going to be probably the single largest plant in India outside China. So, so all these levers are going to aid towards capacity EBITDA expansion going
Just
ahead.
to understand that point better on margins, what are your global peers' margins in the same business? If you could give us a comparable rate in terms of what the peak is, what the low is, and where you are.
So on an industry level, the EBITDA would range between 10 to 15, 16%. So this would be a broad range.
All right. And last year on the EBITDA of 100 crores, your cash flow from operations was just about under 30 crores. How is that ratio likely to be going forward?
So I mean, we made some investment in the renewables. You know, if you see the debt on the company, it is really, really small, the long-term debt. On a revenues of approximately 1,200 crore rupees, we have a long-term debt of only 35 crore rupees. So a lot of internal cash has been generated to invest into the expansions which we are doing.
But that would be cash flow from investments or cash flow from financing. I just wanted to understand about the CFO point.
Right.
But running out of time, we will continue this conversation, maybe press you for a lot more numbers when you guys list. So that's the management that we have of Sandstar. The IPO has been subscribed, guiding for near doubling of revenue over the next couple of years with improvement in margins as well as they focus on expanding their capacity from the IPO proceeds that they have. Take a short break, come back, talk about a lot of the other stocks which are moving around in trade. Infosys is a stock which is gaining in trade today and is the top contributor to the Nifty on the positive side, even though the Nifty is currently sitting with a cut of almost 140 points. It was on account of large deals, a strong India business and a welcome pickup in the BFSI segment that led to a strong growth surprise coming in for the company. In fact, they've also raised their guidance for this year to about 3 to 4% from 1 to 3% itself. So important to listen into what the management had to say post the numbers in terms of the growth outlook for the company going ahead. Let's hear them out.
The way we see what's going on in the market and our guidance, first, we had a strong performance in Q1 on volumes as well as the point that we made on financial services in the US. Second, we had a very strong performance on large deals in Q1, which gives us more visibility into this financial year. And third, we completed the Intech acquisition which also helps us in this guidance.
Last multiple quarters, we have moved to the agile hiring base. That basically means we hire freshers both from the campus, off the campus. This quarter, we had a 2,000% net decline, which is lower than the previous quarters. Our utilization is already at 85%, so we have little headroom now left. So, as we start seeing growth, we will look at hiring. We are looking at hiring 15 to 20,000 freshers this year, depending on how we see the growth.
Okay, so that's the top brass of Infosys talking about their numbers. But let's move on. JSW Infra is down in trade today on the back of muted Q1 numbers. Vivek is here to tell us about the fine print.
Well, that's right. So JSW Infra has had a soft start as far as FY25 is concerned. What's actually happened is that revenue is up 15%. This was aided by volume growth of around 9% on a year-on-year basis. The cargo handle volumes came in at 27.8 million tons. Where did the miss come about? The company that handles significant volumes at Dharamtar as well as Jaipur port, these two port volumes were lower than what the consensus was anticipating on the account of a maintenance shutdown that JSW Steel's Dolvi plant was undertaking. However, what has aided the volume growth? Incremental volume from acquired assets, increased capacity utilization at the Paradeep Iron Ore and Coal Terminal is what has aided the volumes. Now, coming down, as far as the EBITDA is concerned, EBITDA was down by 6% on a year-on-year basis. EBITDA margins, 50.2% versus 61.3% on a year-on-year basis. Effective tax rate this quarter was higher and profitability was down 7.2%. Now, when you're talking about what brokerages have to say, depending on whether or not they had the maintenance shutdown in their expectations going into this particular quarter, the street is divided. BNP Paribas actually has a buy rating. They're quite positive. They say that given the fact that the company has done so many acquisitions, remember Q1, the company has announced the acquisition of Navkar Corporation's majority stake. So they believe Q2 and H2 onwards there can be significant volume ramp up, and on the back of that they believe that the 10 to 12% volume growth guidance that the company has given, the company may actually be able to beat that. On the other hand, Kotak Institutional Equity actually has a sell rating. They are saying that volumes are flattening out on a year-on-year basis. Non-captive volumes housed in assets with limited capacity continuing to drive volume growth. So this is something, a bit of a mixed view, but it's a soft start nevertheless to FY25 as far as JSW Infra is concerned.
All right, Vivek, thanks a lot for that. Let's talk about our special segment, Value Plus, on the show right now. And the stock on our Value Plus segment is VST Industries. It's a 17% up move that we're seeing on the stock. It's a fresh record high. And the reason why the stock has been buzzing around so much in today's trading session in particular is yesterday post-market, there was the announcement that came in from the company on the exchanges saying that the board will consider a bonus along with its results on July 25th itself. So that has the stock excited. But despite that, we have to see a couple of things which are taking place in the tobacco end right now. Godfrey Phillips, the stock which has nearly doubled from the start of this year, is up almost 98% in this year. For the last 12 months, we've seen a bigger move on that one. VST Industries is not too far away as well. So if you look at VST Industries, in this year itself, it's up 40%, including today's move. And ITC has been a relative underperformer there with an up move of just about 3.5%. But, VST, a couple of things happened in the last quarter. If you look at the volume growth for the cigarette business for Godfrey Phillips, ITC and VST itself, pull up both Godfrey Phillips and ITC, you would see that Godfrey Phillips has seen a much better volume growth, whereas VST Industries in last quarter itself turned around on the volume front on a favorable base. All the other companies have been growing much faster. So turnaround for VST is something that the street is betting on this time around, because they may then have to claw back the market share that they ceded to other players like Godfrey and ITC as well. So if you look at the VST volumes, once again, you would see that over the last 6 quarters, we've seen 5 negative, performances, and it was just the last quarter where they turned positive in terms of volume growth. The triggers for tobacco industry in the first quarter in general would be higher pre-buying by dealers ahead of the budget. Typically ahead of the budget, dealers stock up products so that they don't get, impacted by any increase in excise, at least for the stock that they hold in their books. And remember, 16% hike in national calamity contingent duty took place in the budget last year. So the street is hoping this time around there won't be any hike. Even if there is, it won't be as high as last year itself. Triggers for VST Industries in particular would be the appointment of Sanjay Wali, who's ex-Godfrey, as the COO of the company last quarter. So management change would work for them. They've initiated the process of monetizing their Azambad property, which will be completed in this year itself. So that adds additional other income to their overall books. And their marquee investor, Radhakishan Damani, had increased the stake in the company by 3% in the last quarter. Their total holding stands at around closer to 36% itself. Despite the up move, the bigger up move that took place in Godfrey took Godfrey's valuation much higher than VST. So as things stand in the tobacco industry right now, ITC is trading at 26 times, Godfrey at 32 times, VST at 20 times itself, with triggers in place. So let's see where this one goes from here.
Okay, all right, Manglam. Thanks very much for that. So maybe there is a valuation upside for VST along with the volumes turning around. We need to take a short break. But up next, Manish Ramani will join in with his trading calls for this Friday. Stay tuned.
Welcome back. You're watching us here on Halftime Report. Perfect time to get you, what's taking place in the F&O space in midday. In the markets itself, look at it, there is been a bit of a sell-off. The Nifty is down about 165 points. It's lower not only by the Nifty bank, but it's the broader markets which are a little bit of bigger concern. The mid-cap index is now down almost 2% and it was underperforming in yesterday's trading session as well. If you look at the advanced decline chart as well, both these lines have been fairly apart for most of today's trading session, and the distance has been maintained. 2,000 stocks declining, 354 stocks advancing itself. What are the stocks that we need to keep an eye out on for the index itself from here on? Infosys is contributing on the way up after good results coming in. Reliance reports its results most likely post markets today. HDFC Bank tomorrow. So together, these are heavy weights of the index. Infosys, what happens, whether we see a follow on Monday or not is the big question. And for Reliance and HDFC Bank as well, what happens on Monday would be an important, imponderable to track. But that's about Monday. Then we have big triggers for next week, which are the union budget on Tuesday. And then on Thursday itself, we will have the July series expiry. So there would be a fair amount of volatility in the market, which is expected from current levels itself. Ahead of expiry, a lot of active options that we have on the index. 24,700 call, pretty active on the Nifty with 200 rupee premium telling you, around 24,900 to 25,000 may face a bit of psychological resistance. Let's see where that goes, because we're seeing an equal amount of writing on the 24,800 call and the 25,000 call as well. And ahead of big events, we do see some purchase at lower level puts too, and that's exactly what's taking place. So if you look at the 24,500 put, there has been some action for a premium of 200 rupees telling you 24,300 thereabouts could be some bit of a support for the index. 24,200 put as well, fairly active with a premium of 80 odd rupees. Very stock specific market as well, so a bunch of stocks which may be in focus. Vodafone Idea may actually enter F&O ban given the open interest action on that stock today. And the other one that I'm looking at is GNFC, which may exit F&O ban. Remember, there are 11 stocks in F&O ban ahead of expiry next week.
Okay, all right. Manglam, thanks very much for that. Manish Ramani of Deen Dayal Investments joins in to discuss the markets now. Manish, hi, welcome to the show. Well, not usual to see so much red on the screen, but how would you approach it? Would you probably buy this dip that you're seeing?
Good afternoon, Ekta. Well, not really. I wouldn't buy right now because I feel 24,900, which we had mentioned as a target last week, is really the resistance which is there for this week. And that is where we are really reacting. If we are able to significantly, I think 25,500 should be the next plausible target. Immediate short-term support is at about 24,300, while the medium to long-term support is way down at 23,100.
Okay, all right. And what about stocks?
Well, after a lot of buys and few weeks of buy calls, I'm now looking at 2 sell calls this week. The first one is on Hindalco, which is for a target of 630, stop loss of 705. 675 to 700 has seen large sell volume, especially in blocks, which has led the stock to break the support of 675. The stock is even resisted on the upside at 700, which is a testament to the downside. The second sell is on GAIL, which is for a target of 210, stop loss of 230. This stock was in sideways zone between 230 and 235, which is broken down, which makes it a good valid sell candidate. Volumes are supporting the move as well.
All right, Manish, you gave us the upside target on the Nifty, which is close to 24,900, where there is resistance. Now that we are seeing a decline and you say there is no fresh long zone, what are the levels that you're looking at the lower level?
Well, the real support right now is 24,300.
Okay.
Unless we don't hit that, we continue to be bullish. The longer term supports are still way lower at 23,100.
All right, take that point. Thank you so much for joining in and giving us your call on the index as well as a lot of individual stocks. No fresh longs right now. 24,300 is a better level to buy as per Manish, and at the same time, a couple of sell calls that he's given on stocks. But let's move on. Building a legacy from the ground up actually takes vision, perseverance, and the right kind of support. And that's exactly what our new show is. HSBC presents CNBC-TV18 SME Champion Awards, which celebrates this encouraging journey of one such incredible Indian enterprise called Natural Remedies. But what were the key ingredients that fueled this remarkable growth from a small team to a big global exporter? Let's hear directly from Mr. Anurag Agarwal, who's the MD of Natural Remedies.
My name is Anurag Agarwal, and I am Managing Director at Natural Remedies. Natural Remedies was started by my grandfather and my father way back in early 50s. It's been a wonderful journey. I have completed almost 39 years with Natural Remedies. From an institution with around 25 people, now today we are close to 1,000 people. Today our products are available globally. We are exporting these products more than 30 countries across various continents. And we are proud of our contribution. We have a research center which is approved by Ministry of Science and Technology. Almost 12 to 15% of our growth every year comes from the new introductions. We have divided innovation into categories where there is a separate team which works for the future innovation and a separate team which works on the immediate needs of the organization. Finance support has been available to us from various institutions. Since we are an export-oriented organization, funds have been made available to us through the various government schemes at a very reasonable prices. So we feel deeply supported there. So I can see the changes which are happening, and we are happy with these changes. Today, our international business contributes to close to 30% in our total turnover. We plan to take it to 50% in the next 4 to 5 years. Human evolution is the most critical component to mitigate any risks or changes which are happening in the market. And the better we make ourselves, the more fitter we are to respond to the changes and the difficulties which we may encounter going forward in our life.
Welcome back. Well, the other big trigger today in terms of earnings is Reliance. We will be reacting to that on Monday because it will be post-markets. It is expected to report its results later today. The street is looking at a modest rise in EBITDA on a year-on-year basis. Sonia is here with a detailed rundown.
Well, thanks a lot for that. First, let's look at the stock performance. In the past 6 months, the Reliance stock is up almost about 15% at 31.50. Currently, it's had a strong run in the past 6 months. Let's take a look at the numbers as well. On the revenue front, year on year, we're expecting an improvement to 2.3 lakh crores versus 2.07 lakh crores same time last year. The EBITDA is expected to rise to 39,845 crores versus 38,100 crores same time last year. And the profits are expected to rise to 18,432 crores versus 16,000 crores same time last year. Now, what can you expect this time around? The consolidated EBITDA will see a marginal growth year on year. However, sequentially, we are expecting a weaker growth on the back of lower gross refining margins and muted growth in the Jio and retail business. Jio is expected to see stable average revenue per users and 9.3 million overall net additions versus 11 million quarter on quarter. Even the average revenue per user is seen flattish at 182 versus 181.7 last quarter. Now, we can expect a modest 2% quarter-on-quarter EBITDA growth on increased store footprint and operating leverage in the retail business. So, yes, it will be quiet in terms of a sequential performance for the retail and telecom business, but on a year-on-year basis, we are expecting a decent improvement.
All right, take a short break, come back on the other side. We'll focus on the markets and a bunch of stocks which are moving around. At the bottom of your screen, the ticker team keeping you alert. On the sidelines of the Indian vegetable oil, event, we do have with us Manisha, who did speak with Malaysia's plantation minister, Johri bin Abdul Ghani. She quizzed him about his interactions with the Indian edible oil stakeholders and more. In fact, it's a very interesting conversation. We should listen into that.
India is an important market for palm with 1.4 million population, 1.4 billion population. We almost control 36% of the palm oil vis-a-vis edible oil requirement in India. And with the growing middle income population in India, it's a huge potential in India. And this is where we want to make sure that, we want to have the first mover advantage to introduce to India about the sustainably production of palm. I mean, we want to bring our mission, sustainable palm oil, into India to explain to all the Indian players that with this sustainability formula that we bring, that will take any product that they produce, a consumer product, to go anywhere to the world, because the world will accept that. So this is where we want to make sure that we will comply with all this sustainability requirement by the world. As a country, Malaysia, we have committed that we want to make sure that as a country, our forest cover must not less than 50%. So we will make sure there's no more deforestation. Today we stand at 54% of forest cover. You must make sure that there's a traceability of all our products, that when they go out from Malaysia, they must have that traceability, and then they must have legitimate title when they plant the palm oil. And number 4, we must make sure that we comply with international labor practices under the ILO guidance.
Mr. Minister, we do understand that both the countries are quite thick when it comes to especially edible oil. Yeah. There are various policies being made right now. What is your sense on 1, the Indian policies, 2, the Indian demand, which is ever growing, and 3, the sustainability or the food security part of it? So
you must understand that the key factors that we want to play our part here is that India is always stressing on food securities. So likewise, a certain agriculture product that we buy from India, like for example rice, onion, we also concerned with our people. So if we can collaborate together, both need each other, then we can make sure that all our palm oil will be. We will ensure there's enough supply of palm oil for India.
Okay. There is various other things also happening. You've talked about climate change and sustainability and deforestation, of course, but geopolitics, currencies, so many elections happening world over. How are you working with all of this macro changes?
we need to address every company differently. Because we need to know exactly like India, for example. The agenda is to make sure that enough food to take care of 1.4 billion. Then how do you play your role in order to work and collaborate with India? And if you go to any other smaller countries, their requirements are different. So this is where we need to make sure we are very agile in our policies, and we must make sure that, at the end of the day, if you want to have a long-term relationship, it has to be a win-win situation.
I also want to ask one more question. This is an era where we have seen, we have so many FTAs and trade conversations and, those kind of things happening. Where do you stand within that?
Yeah, I prefer to deal, country by country FTA, because from there, both of these countries will be able to have a win-win situation. We can know specifically how to adjust, and if something that it doesn't work, we can sit down. It's much easier to work, rather than you share with so many countries. That will sometimes it will not benefit a certain country, and certain country when we do the dealing, it's not a win-win situation. But however, there's a certain matters that we need to look as a group, that everyone benefit vis-a-vis other region. For example, if you talk about ASEAN, for example, or ASEAN, then we need also to make sure that we protect our market vis-a-vis European, for example. So this is something that we need to work together.
Right. So we've talked about palm oil. One final question I'm going to squeeze in. You also are the Minister of Commodities. How are you looking at the overall bigger game here?
The bigger game here is actually we must always put a lot of effort to increase the yield instead of increase the land usage. So by doing that, we will be able to save the world. We can do business, we can grow our economy without sacrificing, the environment.
You met the industry last evening. There's been a big meeting, I understand, hours and hours. What is their feedback to you?
They're very excited. They're very excited with us, and we're also very excited with them. There's a lot of opportunity that we need to explore.
Okay, so that's the update on the commodity space. We need to take a short break. Just keep your eye out on the markets because there's a worsening which has taken place in the advanced decline ratio as we speak. So the mid-cap index is now down around 1,049 points, but the advanced decline ratio is worsened to the low point of the day, and you can see that the gap is just widened. We have around 930 stocks advancing to over 3,000 stocks which are declining on the Bombay Stock Exchange. For the Nifty, 169 points shaved off, and the Sensex over 400 odd points. We'll wait by to see what the global markets throw up in terms of a European opening as well. But as of now, we need to take a short break. On the other side, we'll focus on Nazara Technologies, which has acquired the remaining stake in paper boat apps. We'll be talking to the management team. Welcome back. Well, a CNBC-TV18 News break is confirmed. Nazara Tech is set to acquire 48.42% stake or remaining stake in paper boat apps. Remember, Rachna brought you this news first on 28th of June. Well, Rachna, congratulations on the news break, and give us more on what you're picking up.
Well, thank you, Ekta. As you said, it is a CNBC-TV18 News break confirmed. We had earlier reported that Nazara is likely to buy remaining stake in Kidopia, which is paper boat apps, for a consideration of about 300 crores, and now it has been confirmed by the company. Now, as we had reported earlier, that this deal would give founders of paper boat apps, which is Kidopia, Anupam and Anshu Dhanuka, an exit. Now let's take a look at Nazara and Paper Boats Association. It all started in 2020 when Nazara bought about 51% stake in Kidopia for a value of about 80 crores. And now 48.42% stake, to be exact, will be bought off for about 300 crores, giving the founders an exit. Now Nazara has been on an M&A spree pretty much this year. They have acquired a lot of companies like Comic-Con, Freaks for You, all in a bid to expand their presence in youth media and esports space. But Kidopia deal is a bit different because they already owned about 51% stake in the company. Now, this would mean that they will now have an absolute and full majority control on the company, on the subsidiary, which could mean a lot of revamp is expected within the company. Now, Kiddopia has a subscriber base of about 2.5 lakh with a revenue of about 220 crores and an EBITDA of 55 crores as of end of FY24. So this could mean a lot of new changes coming in for Kiddopia, as the founders will now exit the company, and all the control will now lie with Nazara Tech and Nitish Mittal Sen.
Take that point, Rachana. Congratulations on breaking that story. But for all the questions, what happens to Kiddopia going forward? We are now joined by Nitish Mittal Sen, who is the joint MD and CEO at Nazara Tech, to discuss this acquisition in detail. Thanks a lot, Nitish, for joining in. The first obvious question is that when you first acquired this company, it was at a net valuation of close to around 150, 160 odd crores. In the next 4 years, when you bought the remainder, the valuation has jumped 4 times, close to around 620 crores as per this round. What caused this significant jump in valuation where the underlying business did not grow as much? And where are you funding this from? Because I look at your numbers, the cash and equivalents that you have on your books are close to around 155 crores. So will you be taking debt to fund this?
Sure. So a couple of points there. One is when we acquired the majority stake, 51% in 2019, the business of this company was around 20 to 25 crores annually, compared to about 220 crores now. So it's almost grown 10 times in the last 4 years versus the valuation that we paid, which is about 4 times. It's also important to understand that the 620 crore value that we prescribed to this company, the Kiddopia company or the paperboard company actually has 155 crores of cash as of March end. So net of cash, the value actually is closer to maybe about 450, 460 crores, which I believe from a Nazara perspective is extremely value accretive to our shareholders, as well as the potential for us to grow the business now. We have specific ideas how we can, in recent quarters, some of the issues we faced in terms of growing the subscriber base. We have some very good ideas that we hope to implement in the coming months, which will hopefully show a new spurt of growth. In terms of the cash question that you had, Nazara today has cash equivalents of nearly 1,100 crores. The 155 crores you are mentioning is actually the cash on the balance sheet of paperboard apps.
Okay. All right. So just wanted to understand, you're saying that the business for Kiddopia has grown from 20 to 25 crores in terms of business revenue in FY21 to around 220 odd crores currently?
That's right.
Okay. What about the subscriber base? And if you could compare the numbers on an FY23 to versus 24 basis for us, because we do understand that there's been some amount of sluggishness which has taken place in the business. So if you could just share what the subscriber rate was in terms of addition FY24 versus FY23, as well as the revenue and EBITDA levels, and whether there's been pressure in this business.
So FY23 revenues for paperboard was 220 crores versus FY24, which was 219 crores. And our EBITDA actually improved in FY24. We were at FY23 about 35, 36 crores, which increased to 56 crores in FY24. That said, the subscriber base was flat for us, largely driven by pressures on the user acquisition on Apple in the US. But like I was saying, I think we found other ways that we can work around this. And one of the reasons we've taken full control of this company is to be able to execute fast some of the ideas that we have. We think just the US market is much, much larger than what Kiddopia is operating today. And it's really become a very loved franchise with kids in the North American market. We also think the India market can be a very interesting opportunity and is one of our growth strategies for this business. I think over the next quarter, we will launch India first model for Kiddopia, which also we hope to grow over this year.
So the stagnating revenues at around 200, 220 crores over the last 3 years with, net profit being anywhere between 30 to 40 crores as well. Where does this number scale up to, say, 2 to 3 years from now, after you've done all the strategies of fast-paced growth and changes that you aspire to do here?
I mean, I wouldn't want to give a guidance, but I think, anything less than double in the next 3 years, or at least double in the next 3 years is what we should really aim for, and my team should strive for.
All right, and quickly because we have you with us right now, there was a GST demand notice that came into 2 of your subsidiaries. It was close to around 1,120 crores. What's your comment on that? and what are you doing to mitigate that risk?
So this is part of the ongoing GST issues for the real money gaming industry, which we're well aware of, and I think over 1.5 lakh crores of GST demand have been put on it. So I think Nazara is relatively small player in that space, and of course the 1,000 crores sounds like a large number, is a large number also, but in context to the overall industry, it's still not very large. The subsidiaries have their own managements and boards which are looking into the matter, and they will take the right call. But generally, if you look at the whole status of this current issue, it's really awaiting hearing at the Supreme Court. So I think we will see how that pans out. The other thing is the industry is anticipating that with the recent inclusion of, clause.
Right.
Anyway.
All right, we've completely run out of time, but we're going to continue this conversation. Thanks very much for joining in and speaking with us. So that's Nazara Technologies. We need to wrap on the show. Business Lunch up next.